Hello, Business 330 students. This is Professor Hassey recording our Week 6 Saturday weekend update video from my office at the beautiful campus of the University of La Verne. So welcome everybody to this Saturday. You're all finishing up and completing our 2-week assignment in assignment number 4. We'll talk about that in just a minute. And then to be aware, on Sunday of this beginning of the ending of Week 6, Sunday, October 1st, I will be posting the final examination to Blackboard. I'll talk about the final examination and introduce it in my Week 7 video on Monday and Tuesday. But that will be posted tomorrow. For you have 2 weeks to do the final examination week work to conclude this class. Especially for the online students, if you have any questions or concerns about that final examination, make sure. Remember, we have our Thursday evening office hours, student hours, every Thursday from 6 to 8 o'clock. Some students are beginning to come onto that session on Thursdays, and I believe it has helped them just get a better handle on the material that you're working on. So we are ending our Week 6, and we have our capital budget analysis problem and interpretation to do this weekend. Remember, there are extensions available if you need it for this assignment 4, but we did have 2 weeks to do it. But again, if you need a couple extra days to review it, let me know. That is allowable. Just to repeat, there are no extensions going to be allowed for the final examination, which you'll have 2 weeks to do, beginning October 1st and due October 15th. There can be no extensions to that work. Okay, so let's just talk about assignment 4 briefly. So assignment number 4, again, is worth 20% of your course grade. And what it is to do a spreadsheet capital budget analysis of this project. The investment in the project is $750,000 over a depreciable life of 5 years. You're given the variables to determine the cost of capital. U.S. Treasury 10-year yield, or the risk-free interest rate, is 4.31%. The market return, or the S&P 500 return rate, is 12.5%. The capital structure of this particular company is 55% debt, 45% equity. The firm's cost of debt is the prime interest rate plus 3%. So you'll need to go to the internet and a wide variety of sources from that. For that, you could just type in prime interest rate and you add 3% of that. That is your company's cost of debt. And the company's risk or beta number is 1.4. So once you calculate the cost of debt and taking the input variables to determine the project cash flow, you're asked to do on a spreadsheet the net present value return analysis, internal rate of return, profitability index, and payback in years methods. Once you have that completed, then I'm asking you to do a 1 to 3 page paper explaining these 3 questions. Explain the cost of capital as a variable in your analysis. What is the cost of capital and how does it influence your capital budget analysis? Would you recommend this project after your analysis, and why? If you do not recommend, why not? What are the key factors that determine or made up your recommendation to approve or disapprove? And then finally, going forward, what adjustments would you recommend to make this project produce a greater return? Let's say the return is not that good, or in other words, not acceptable for what you're trying to do. If you need to make this project perform better return, what would you do to make it have a more profitable investment return? Give me your interpretations of that question as well. So 1 to 2 page paper, double spaced, and no, this is not an APA format, so you can just write the answers down or type the answers down on a piece of digital paper, Word or PDF. I prefer Word. And then post this file along with your spreadsheet file And that's assignment number 4, 20% of your course grade. I provided a template spreadsheet file for you to do your work on. In other words, every student should be preparing their analysis on this file. No other files. No PDF, no taking a picture of it, no writing it out, all done on this digital file. And there's 2 tabs for you to complete. I want to see your calculation for the after-tax cost of debt. I want to see your calculation for the cost of equity, or the what you might want to call the expected investor return on equity of this company. And then finally, combining those 2 to determine the weighted average cost of capital. Then you go to the next tab, and you now have that weighted average cost of capital, which would go right here. And then you have your other variables given in the problem. And then I want you to put these variables into this net cash flow format, determine the 5-year cash received or dispersed negative over the course of the 5-year depreciable life. And then once you do that, determine the discounted cash flow using your cost of capital, and then calculate the NPV or return in dollars, the internal rate of return, the return in percent, the profitability index, the return in a ratio, and the payback in years. And that'll give you all the data and all the reason to interpret this in the second part of this assignment on the 1 to 3 page paper. So that's your analysis. We have had numerous practice sessions of types of investor return. Let's take a look at the most recent one. During week 5 and 6, we looked at samples of capital budget analysis, how to determine the investment return criteria, how to determine cash flow, how to determine and understand the risk in the cost of capital, the risk in the project. And we put it all together in a problem that we looked at and summarized in this week 6 at the beginning of this week, which was, and you had to do it last week, is to determine the capital budgeting process. What is that process of determining return on a projected investment in asset? Well, we first of all learned about the weighted average cost of capital. The weighted, again, this is in week 6 in your review file folder. So with the weighted average cost of capital, which is taking the after-tax cost of debt plus the expected investor return or the cost of equity, using the capital asset pricing model with the various market indicators and risks, combining that with the capital structure of the company to determine your discounted rate, your cost of capital, your weighted average cost of capital. That is the number we're looking for assignment 4 to calculate. After-tax cost of debt is the interest rate on the company's debt times 1 minus the company's tax rate. The cost of equity, or the expected return required by investors using the capital asset pricing model, is the risk-free interest rate plus the market premium times the beta of the company. The market premium determined by the market rate of return minus the risk-free rate. Weight those by the percentage of capital structure of debt and equity, and there we go. That's analysis number 1 of your assignment project, and this is a problem we did in class this week. Taking that 8.83%, then we supplement it into a capital budget analysis. Remember, in week 5, we did this same thing, but we were given this number. In week 6, we had to calculate this number. And here's that calculation. It's a combination of taking all the variables, investment in year 0, the amount of sales on a per unit basis times the number of units you expect to produce, including the inflation rate beyond year 1, taking the 3 types of expenses, variable costs, which is a per unit rate times the number of units you produce and sell, the fixed cost, which is a basic flat cost every year, and the depreciation, which is given to you in the problem. You have to inflate the two costs per whatever inflation rate you have in that particular project. Taking all that into effect, you take the tax, take out the tax from the earnings before taxes, and determine the net income of the company, of the project. Then from net income, you allow for 3 additional cash flow items. The after-tax salvage value of the asset at the end of its depreciable life. The depreciation is added back in as a non-cash expense. And the net working capital, which is additional cash needs to manage the asset of the investment, which is a percentage of the following year's sale. And that percentage is always based on the following year. Remember in this problem, 12% of 500,000 is 60,000. 12% of 512,500 is $61,500. Thus, we have to have an additional $1,500 of cash flow for that project. And then it goes subsequently until the final year of the project, where all those working cash flow disbursements are added back in to net the whole project life of working capital to zero. Take that all into account, and then you have your net cash flow, and the rest we've done beginning in Chapter 8. Determine the discounted cash flow with your weighted average cost of capital. Determine the net present value in dollars, the internal rate of return in percent, the profitability index, which is the relationship of discounted cash flow to the net cash investment, and the payback in years. How long does it take you to pay back in your expected cash flow the net investment in year 0? According to this project we did in class, it was all pretty profitable, good return, and we allocated a go to accept this project. You have to go one step further in assignment 4 by explaining to me why you said go or no go. That's the nature of the paper. So that's our work backup to do assignment number 4. So remember, next week we begin the last 2 weeks of our course, where a lot of this material will be part of your final examination. We'll talk about debt financing and dividends next week. And our final week, week 8, we'll talk about long-term and short-term planning in financial management. So good luck with your work this weekend. Take your time. Make sure you're answering all the questions and doing the right interpretation of the questions. And we'll see you all in week 7, where we end the final 2 weeks of the course, and look for our final examination to be posted tomorrow on Sunday, so you can begin your work on that. Have a great weekend, everybody. Mr. Hassey saying again from the University of La Verne, adios.